you can present. Start.
Okay. Uh, are you able to see
Yes,
my
yes,
screen?
yes. I am able to see, but I am
Okay.
unable to see your face, this man. Your nice face. Mm. Okay, Jisman, you can start.
My name is Jismon Tommy, and the name of the practical that I am going to present is return on investment on DuPont model. And the purpose of calculation is return on investment is a performance measure used to evaluate the profitability of an investment. Uh, and the input data that I have taken is profit and loss statement of Birla Corporation and balance sheet from Money Control and the DuPont model. This is the template of DuPont model where we have to change the gross revenue, the data input area so that we can get the ratios perfectly. So first one is gross revenue. So, gross revenue is taken from P&L revenue from operation of March 2020. And um, next is variable expense that is from that is also from the P&L that is employee benefit expense. And the next one is fixed expense that I have taken from depreciation amortization expense. And the next one is other income. Uh, it is also from profit and loss account uh, statement that is 82.48. And the next one is total assets, which is taken from the balance sheet. Um, and the next one is total liability. Liability here means the total current liabilities that is 1,301. So after we alter the amounts, we can get the ratios as operating profit margin as 0.922 and asset turnover ratio is zero point 0.5, return on assets 55.025, spread above interest cost is 40.80%, and debt to equity ratio is zero point 0.2, and return on equity 63.129. And the decision I have taken is uh, the asset turnover ratio of Birla Corporation is low compared to the other companies in the cement industry, and the debt equity ratio of Birla Corporation is better so that they can borrow money easily, and the return on assets is excellent, that is 55.025, and the also the return on equity that is 63.1 is also good. So the application of ROE that I got is that it is the simplest measure for an investor to calculate the return on investment, and it can evaluate different investment opportunities, and the it can calculate and compare returns with previous periods. Also, the it is a very good indicator for investment. So that's it. So,
Okay. Any news you are clippings you identified?
uh, not really, sir. I got only this.
Hmm. Okay. So, what is your final decision? Because you are
We
mentioning and that the return on investment is good and return on equity is 63 something percentage. Okay.
we can directly invest, sir.
So, the fundamentals are very strong.
Yes, sir.
So, you are ready to invest in this company. What is the name of the company?
Birla Corporation, sir.
So, if you are an investor, you will invest in Birla Corporation.
Yes, sir.
How much you will invest?
Uh, 50,000.
Okay, you are planning to invest 50,000. So you are expecting your amount will be doubled within 3 years.
Yes, sir.
Mm. Okay, Jisman. Uh, we'll say you can wait for the question time at the end. Okay. Mm. Okay, you can stop sharing. We'll move on to the next person. See the screen. Start.
Okay, so good morning, sir. So the topic that I have got is Monte Carlo simulation method. So basically, we use this method to predict the probability of different outcomes when the intervention of random variables is present. That is, in the case of a market, there might be different factors that influence the price of the stocks. So, with the use of this Monte Carlo simulation method, we would be able to predict the future prices of the various stocks uh, from the current scenarios or the factors that influence these stocks or the prices. So, to begin with, we can go for the uh, yeah. So this is the template that have been shared. So here we can see that there are many terms that has been defined here. So first one is drift. So what we mean by drift? So drift is the percentage of change if some unprecedented event happens. So drift actually defines the percentage or the amount in which the stock prices vary due to the effect of some unprecedented events. When I mean by unprecedented events, it's usually short-term events. We do not consider any long-term influencing factors, rather than we consider short-term influencing factors, and moreover, we do not consider any abnormal factors that happens in the market, such as any natural calamities or terrorist activities. Those kind of abnormal activities we might not be considered under this method, but rather we consider normal short-term influencing factors. And what is volatility? Volatility is the uh, is standard deviation. It is the standard deviation that measures based upon the beta value. And next is initial price. Initial price is the price that the stock currently has right now, and on which we calculate these method. We calculate the method. So in the first, what we usually see here in the scenario is that we will take three conditions of drift value each. In the first case, we will consider the drift value as you can see here. First, we will consider the drift value as 11 percentage. Normally, the BSE market disclosed the drift percentage as 12 percentage. So in the current scenario, we will consider it as 11 percentage, and we will take the volatility as 16 percentage, and the initial price as 1,200. So in this case, if we give the value here in this template as drift as 11 and volatility as 16 and the initial price as 200, and here the price column will change accordingly. And when we go downwards, when we click on this generate future prices, the last that is column that is cell uh, F118. F118 will give us the value of the future price of the stock under the various simulations that the template has been worked on, and it conducts around 1,000 times. That is, when we click on this option, it conducts around 1,000 times to generate 1,000 such future prices. So we get a final value here. So that is what we get here under simulation 1. And simulation 2 also we does like that. So we will get the future price of uh, the stock which had the initial price 1,200. And under the second scenario, we will increase the drift value. That is we will increase it from 11 to 16% under the same features, that is volatility 16% and initial price 1,200. where we could find that if we give 16%, the price value has been decreased to 1,204 and 1,203. And again, we will given the third option, we will also decrease the drift value and we will give it as 9%. And again, the stock price has been decreased to 1,199 and 1,200. So this is the calculation that we does in this Monte Carlo simulation, and the conclusion that we get is that when the drift is decreasing, the price is also decreasing. So it depends upon the stock price that I am taking, and also it may give different results to different persons according to the values and the stock they are taking. That is what. So this is what basically Monte Carlo simulation method gives. It helps us to generate the future value of prices by considering various influencing factors that can happen in the market. And there is one more part, that is Monte histogram, but since my system won't support the virtual this virtual platform, hence we can't perform this. So this is the Monte Carlo simulation method. Thank you.
Okay, Jacob, whether you will be here for 1 hour or you are leaving?
Sir, I am leaving. I need to log in for my work. So
Okay, then we'll wait for 2 minutes. Now, students, you can ask question to Jacob, any specific questions, because he won't be available throughout the class.
Okay, good
Start.
morning, Manala. Sir, shall I start?
Yes.
Okay.
Jojen.
So good morning, Manala. Present here. The topic for today is efficient market hypothesis. Efficient market hypothesis holds that is when new information comes into the market, it is immediately reflected in the stock prices. Neither technical analysis or nor the fundamental analysis can help an investor. The purpose of the EMH is that it states that share prices reflect all information. The image hypothesis that stocks trade at their fair market value on the exchanges. For that, I downloaded 4 companies' stock prices from BSE for 31 days. So the next step is to find the expected return and standard deviation of each stock. So I calculated the expected return of 4 companies and standard deviation of 4 companies and their weights, and move to the next step. We need to we need them for engineering calculations. So we added number of columns 1 and number of rows 4 because we selected 4 companies. Then move to the fourth step. We have to transpose the matrices for expected returns and weights. And so we calculated the transpose matrix for each companies. Then we for next step we calculate the covariation matrix. So we use the covariance formula. Then these are the templates which I downloaded from the LMS. So then then we find the portfolio return as 1.7, and then portfolio risk is 0.37. So these are the weights of each company's. Asian Paints is minus 118.6, MRF 116.7, and SBA 13.5, and Hindustan Petroleum is 26.4. So we find with the conclusion that Asian Paints is in short form because short form it is point that is short, and MRF, SBA, and Hindustan Petroleum is if the position is long. This is our output and the decision which I got. The weak form efficiency test states that the prices, historical values and trends can't predict the future prices. Weak form efficiency is a element of efficient market hypothesis. Weak form efficiency states that stock prices reflects all the current information. Then the strong form version of the efficient market hypothesis states that all information, both the information available to the public and any information not publicly known, is completely accounted for in current stock prices, and there is no type of information that can give an investor or advantage on the market. Um, the news which I got is that announcing America EU outfitters stocks or an existing exciting 355% in the last year. So it's also good to see the share price up 46% over the last quarter. And looking back further, the stock price is 78% higher than it was the 3 years ago. That's what's
You can show that one sheet 5.
this one's that's a link
Yes, a link you can show.
to the link.
Mm. You can share that link. I think you find it very difficult. Mm. Okay, why the Asian paint is having a weak form?
So the historical data are shown like that. So
Hmm?
we can predict the future.
But usually Asian paint market thing, it is good. The brand name is good, even compared with the MRF. Hmm? But you are saying that the MRF is in strong, Asian paint is in weak.
So the data which are collected from the 19 January. So
Mm.
that first
Nine-
January 2019.
Mm. So in those period, it was
Yes,
not
sir.
good. Okay, Georgian, you can wait. Mm. Okay, good. Any of your news clippings you are unable to see. Facility.
So good morning, sir. My topic is intra-portfolio correlation. This is my input data, sir. I have taken 5 companies, sir: Infosys, TCS, Reliance, Tech Mahindra, and Tata Motors. This is calculation part, sir. Intra-portfolio correlation. Intra-portfolio correlation allows us to understand how good our portfolio is diversified. The intra-portfolio correlation coefficient can be from -1 to +1. The closer is to -1, the more diversified your portfolio is. The closer IPC is to +1, the lesser diversified your portfolio is. So let's create. Okay, sir. So first I have calculated prices and percentage changes, sir. Here I have taken closing prices in prices, sir, all 5 companies. Next one is percentage change, sir. For percentage changes, having 2 formulas, sir. First one is open price minus close price divided by open price, sir. Second one is open price divided by closing price minus 1. I have taken second one, sir. So I got these all values here, sir. Next one is 1 minute, sir. Step one, creating a portfolio. This is my company names. Last price. This last price I got here, sir. Uh, April 21st values, sir. I have taken these values here, sir.
Okay.
Number of shares I have taken randomly. Position. Next one is position. I have calculated last price into number of shares. I got this position values, sir. Next one is share in portfolio. I divided position value divided by total position value into 100. I got share in portfolio value, sir. Next one is step 2, calculation of IPC. Calculation of IPC according to this formula. I have calculated correlation matrix for all 5 companies. Next one is weight matrix. This weight matrix I got here in step 1, share in portfolio value. For Infosys, we got 23.6%. TCS we got 10.9%. So like that, I taken here, sir. weight matrix. Next one is weight multiplication matrix. For weight multiplication matrix, one minute. For weight multiplication matrix, having this formulas, uh, having this formula. So according to this formula, I have calculated for 5 companies. Next one is final matrix. For final matrix, we have formula that is weight multiplication matrix into multiplication weight multiplication matrix. Uh, for examples, I will give example 0.05 0.056 into 1.00. We simplified means we will get this values. So like that only I calculated remaining 4 companies. Next one is IPC. Now to find IPC, we just need to sum up all the values in the final matrix. IPC, uh, I, final matrix first column value, and final matrix last column last column value. With the help of these values, I have calculated this IPC inter portfolio correlation values. Now we will need to know which percent of diversification risk we removed. It is simple. Risk removed, for risk removed, having a formula, sir. Minus 0.5 into IPC divided by 0.4 0.5. We simplified means we'll get this 28.2%. This value we consider as a using diversification of our portfolio. This is a non-systematic risk. That's it. Changes the number of shares in portfolio experiment with this coefficient. Remember the lower correlation between the assets in your portfolio, the better diversified it is. So decision and suggestion is 0.4367. It is IPC value. So it is greater than minus 0.3. Since IPC is greater than minus 0.3, the portfolio is not diversified. Suggestion: the portfolio is to be changed. So this is my snapshot. So correlation as a measures of market. Correlation can be used to gain perspective on the overall nature of the large market. For example, back in 2011, various sector in the S&P 500 exhibited a 95% degree of correlation, which means that they all moved basically in lock steps with each other. It was very difficult to pick stocks that outperformed the broader market during that period. It was also hard to select stocks in different sectors to increase the diversification of a portfolio. Investor had to look at other types of assets to help manage their portfolio risk. On the other hand, the high market correlation meant that investor only needed to use simple index funds to gain exposure to the market rather than attempting to pick individual stocks. Thank you, sir.
Okay, good. Good. What is your final decision? Whether you have mentioned that we have to change the portfolio. Huh?
Yes, sir.
Why we have to change the portfolio?
So, uh, so because 0.4367 is greater than minus 0.3, sir. So it is not diversified. So we want to change portfolio value.
Okay. Okay, you are correct then. Why you are having more fear, Karthik? Your answer is correct. Okay, Karthik. Wait for the end. Huh?
Okay, sir.
Start now. We are unable to see your face.
So just a minute, sir. So are you able to
Yes,
see me?
start ma.
Yes, sir. My name is Andrita Thomas, and today I'm going to present the practical variance, and the purpose of calculation, which is it helps to understand why fluctuation happens and what can or should be done to reduce the adverse variance. This eventually helps in better budgeting activities and even for investments. And so the data which I took is Bharat Petroleum Corporation Limited, and this is the data which I chose. This is from January 1st, 2020 till December 31st, 2020. And when going to the calculation part, it is very easy to do because first we need to copy paste. There is a template. This is the template. So first we need to copy paste the date and then the closing price, which is already given in the data. So I hope you can see it is there on top. We can see the closing price. And in the calculation part, if we just copy paste the date and the closing price, we will get the daily return. And to calculate the daily volatility, what we need to do is that we just need to do a calculation. That is the we have already one equation, that is equal to standard deviation. On top you can see that, and then select the entire D cells, and then we will get the answer. And when we are talking about sorry, the daily volatility, it is showing, yeah, sorry, that's a mistake when I talk, because the daily volatility, which means the maximum, it it shows it shows the entire sorry, the whatever I spoke was correct. It shows from the entire from the daily returns. This is the equation which we are using. And when we are talking about the annual volatility, uh, this will be generated automatically with the help of the template. And when talking about the decision making, this is the decision which we already got. The as per my data, the output and decision making, the output is the maximum volatility is 15.1. So as per the data, that is the maximum volatility. And when talking about the daily volatility, as it is shown in the template, it is 3.30. So from this, what we are able to tell that decision cannot be made. So how we can tell that decision cannot be made? If the variations are increasing, then we can tell that decisions cannot be made. And for like if the weights are somewhat equal, then the decisions can be made. If the variation is exceeding, then the highest value, then it is ways to calculate the volatility. So that is the decision that we should make. And when talking about the variance analysis, its importance, it helps managers in making efficient and detailed and forward-looking budgetary decisions, and also acts as a control mechanism, facilitates assigning responsibility and engages control mechanism on departments. And when talking about the limitation, based on financial results which are released much later, and because it is based on the past data, and also budgeting exercise may be loosely done, which is bound to deviate from the actual numbers. So the news which I took, this is from the Economic Times, and the news was this is on the news was updated on May 7th, 2021, 11 a.m. And as per the news, it is just a minute. And as per the news, it is telling that for in the current situation, it is very like the volatility helps to invest in long term and medium term investments. And when it is about the in the current pandemic situation, it is very good to invest in Reliance Industries, Infosys, Hindustan Unilever, State Bank of India, then ICICI Bank, Sun Pharma, HDFC Life Insurance, etc. That is all about my presentation, and thank you.
Okay, ma. Can show your first sheet cover page.
Yes, ma'am. Yes, sir.
You can see the spelling for variance.
Sir. Sorry, sir.
Okay, anyway, it is not a big issue,
Yes,
but
sir.
you must know. Okay, why we can mention we can't take the decision for this Bharat Petroleum?
Sir, here it is. The maximum volatility is 15.1. and the daily volatility is 3.30. And if it is if it is less than 10 or if it is more than 15, it will be so we can tell that we can't take a proper decision.
Because the volatility is high.
Yes, sir.
You have to mention the volatility will be high. Okay.
Yes, sir.
Okay, ma, good. You can stop sharing.
Okay, sir. Thank you.
Voice is clear, sir.
Voice is somewhat clear.
Name is Karthik H. Name of the practical ratio analysis. To calculation to analyze the Cisco company's growth ratio, profitability ratio, activity ratio, liquid ratio, and solvency ratio.
Yes, you can proceed. You are able to
Yes,
share.
Calculation of the ratio by using the income statements, balance sheet, cash flow statement, and the share information. The data will be collected from the Yahoo Finance. Calculation of the growth ratio in the year of 2020 and 19, sales growth, it's showing the negative calculate the growth ratio in the year of 2019 and 20. Sales growth ratio, it's showing a negative -5% in the year of 2020 and the 5.2% in the year of 2019. Sales growth of Cisco is lesser than the previous year, which states that there is a decrease in the net sales of the business from the fiscal period. Next, income growth, it's showing it's also showing a negative -3.5% in the year of 2020 and the 4.5% income of the Cisco, which was a negative in the year of 2020. Next, growth. Over time, the asset growth of Cisco has been decreased from 5.7 to the 0.8 over the period of time. Next, calculate the profitability ratio. Profitability ratio measure to business ability to earn the profits related to their associated expenses. Profit margin is increased due to the increase in the sales, 22.4% to the 22.7%. Next, return on asset. Asset is 33.3% in the year of 2020 and the 35.6% in the year of 2019. Return on asset shows the percentage of a profit of a company earns in relation to its overall resources, but the ROE also decreased due to that decrease in the sales. So return on equity is increased from 30.3 to 31.4%. Dividend payout ratio, it's showing a negative value, -54.3 in the year of 2020 and the -50.8 in the year of 2019. Price earnings ratio is also increased because there is an increase in the share price of the company. Next, to calculate the activity ratio in the year of 2019, it's also decreased from 9.4% to 9 due to the sales of the company has been decreased. Showing nil, and the fixed indicates how well the business is using its fixed assets to generate. In case of Cisco, there is an increase 2019 to 20.
Okay, proceed. Okay, students, now you can start your questions. Yes.
So Cisco company. This is Cisco company.
You can come to a conclusion, Karthik. No issues.
Okay, sir. Okay, sir. Okay. Snapshot from the Economic Times. Joel magic formula to spot the multi-bagger stocks for the long-term profits. As investor Joel says, investors should follow a long-term investment strategy in order to able to invest the above average companies when they are available to below the average prices. And the Warren Buffett, he says, however, the buying a good business at the bargain is even better. Yes, sir. Thank you, sir.
15 or something like that, then the decision which can be made, we can't take a decision based on that. And for just for an example, I'm telling that if the variation, if it is 20, and if and in such case, if the like the if the maximum is 10, and in such cases it is based to take a decision. So better, I preferably I am telling that it is better if the range is between 10 to 15, then we can take a good decision based on that.
Okay.